Hello there, everybody, and thanks so much for joining us today for one of our weekly Fortune 500 focused webinars. My name is Sam, and I will be your moderator today. And in just a second, we are going to be joined by Patrick Ray, one of our financial advisors here. Patrick is going to speak on reducing tax time anxiety by providing you some effective tax saving strategies. And if you stick around after his presentation, Patrick will also be answering some questions. But before he comes on, I'd like to very quickly remind you that we are not affiliated nor endorsed whatsoever by any specific Fortune 500 company. We are a completely independent group of financial advisors here, so please keep that in mind as you're listening along today. And after this presentation has ended, you will be redirected to our homepage where you can book an appointment with either Patrick himself or one of his colleagues if you wish to speak to them directly about your specific concerns or situations. So take advantage of that. And without further ado, here is Patrick Ray.
Hello, everyone, and welcome. Thank you very much, Sam. Hopefully everyone's having a great day, and we appreciate you joining us this afternoon. And it's tax time. So what better information can we pass along to you than tax-related information? And so today we're going to talk about a number of things, actually. We're going to just get into some deduction and credit discussion. We're going to talk about some income and tax strategies that you might consider, either be it while you're working and or while you're retired. We're going to talk about some investment and some saving strategies as well. And then we're going to talk about the planning process and where people fall in line with utilizing some of these strategies to their personal benefit. So optimizing your deductions is clearly a given, right? So especially for those of you who are doing your own taxes, you may want to brush up on these because a lot of these things are new, or they get indexed, or they get changed depending on administration and years and those kind of things. And so this is something that you certainly want to stay in tune with if you're doing your own taxes, or obviously if you're paying a professional to do your taxes, like a CPA firm, as an example, you would expect that they would know these things. And so with property and state and local deductions, those are capped at $10,000. For those of you who don't know, the interest on your mortgages have changed. So if you had a mortgage that was initiated prior to December of 2017, there was a deduction that was limited to up to $1 million of interest. That has now been reduced to $750,000 if your loan originated post December of 2017. Of course, there's some deductions related to your medical expenses. And for those of you who have exorbitant medical expenses, this may be an issue, but for many of us, in the event that you hopefully are healthy and you don't have a ton of medical expenses, this is going to be tough to hit because of the new standard deductions that we're all using, or at least most of us who are enjoying the standard deduction, which typically adds up to more than what used to be relevant to your itemized deductions. And so this one is effectively tough to hit, but nevertheless, it is a deduction. And then there are some child-related credits that you might be subject or available to receive, depending on how old your children are, and depending on how many of children you have that are related to this particular child-related credit. So the one thing I'll point out on this slide is that there are some adoption credits that not only apply to the tax side of things in relationship to getting a credit if you're considering adoption, but there are also rules to help you in the event that you need funds to be withdrawn from your IRAs that allow you some flexibility in the event that you're not 59 and a half. And so that may be relevant to some of you who are considering adoption as a way to bring a new family member into your family. And so that's certainly something to consider. Certainly something that's newer in the most recent few years, which is the relationship of having a energy efficient car or an electric car. And so there are now credits on that front to 2 degrees. One is a solar tax credit. So many states even benefit you from credits and additional savings on your electric bill. As an example, if you do solar panels on your home. So that's an option that includes solar panels and water heaters and those kind of things. And so that may be something that you wish to look into, because that's a credit up to 30% that you could receive, as well as there's a vehicle tax credit that ranges somewhere between $3,750 to up to $7,500. And it depends on your income and the price of the vehicle that you purchase, and the manufacturing guidelines and those kind of things. But certainly all something to consider if you're looking to be an energy efficient person and apply that to either your home living with respect to solar panels or your driving living with respect to having an electric car. So that's certainly something to consider. As far as your retirement contributions are concerned, most of us who are still working have an option to contribute money to a traditional 401k from your paycheck. And so, of course, if you take those funds and put them in pre-tax, you're removing those from the taxable income that you have in the given year that you make the money in exchange for a taxable environment or a taxable scenario when you withdraw the funds at some point in time in the future. And what's great about the contribution limits, which are typically indexed for inflation, that you can get up to $23,000 if you're under the age of 50 and upwards of $30,500 if you're over the age of 50 during the 2024 tax year. Now, as a caveat or an additional piece of feedback or information for you, that if you are overfunding your plan, and your 401k plan allows it because your company allows you to overfund your plan, because some companies do not. It allows you to put in an upwards of 60 some odd $1,000s, and I'd have to refresh my memory on the exact number, but you can actually put a larger amount of money in after taxes, which then in most cases you can move to a Roth IRA. So something to consider with respect to having funds payable to a scenario where you can get them out of your taxable environment, growing in a 401k, and move to a Roth IRA, which grows tax-free, of course. So your contributions, of course, may be deductible, and it depends on how much money that you earn or make. In addition, that if your company allows you to contribute and or participate in some of these things that I was referring to with respect to your 401k, so there's a lot of options that could be relevant underneath this retirement contribution link or slide that may be of benefit or relevance to you. For those of you who have health savings accounts, those contributions to an HSA are also tax deductible, similar to a pre-tax part of your 401k. And what's beautiful about this is, of course, you can remove the money on a tax-free basis as long as those funds are being aligned or earmarked to pay for qualified medical expenses. And there also should be another bullet point on here which says that you don't have to use the money by the end of the tax year like you did your flexible spending accounts in years past. So if you have a flexible spending account, you're required to use those funds by the end of the tax year, whereas in your health savings accounts, in the event that you don't use your health savings accounts, they can technically be used for potential income in retirement years if you so choose. So certainly some benefits from the HSA side of things. The Social Security relationship and discussion that we typically have with clients is sometimes confusing because many people think that, of course, by definition, your Social Security is taxed by default. But how it applies to you when you withdraw them, some people don't know that you have to pay income tax on what you withdraw from Social Security. So it's an effective tax on both ends, if you will. And in a nutshell, you should be prepared, and dependent on your income and the total amount of household monies that come in a given tax year will dictate what range of percentage you will pay on that Social Security income. And typically it falls somewhere between 50 and 85%. So when we have people who are already retired, as an example, and they're using an income strategy that we initially established, and then they start to consider Social Security, it may bring some additional things into play where maybe you could use an additional tax enjoyable or favorable environment to withdraw additional monies from your IRA and start a conversion strategy of some sort if you hadn't already considered that. And that would be because maybe the Social Security amounts that you're withdrawing don't hit your tax return in the same context as your withdrawals from your IRAs. So that's one of many things that we talk about when we talk to our clients about a tax efficient retirement. And speaking of taxes, with respect to those of you who have pension income and you're retired, depending on if you live in a state that taxes pensions will dictate if you're paying both federal and or state tax on your pension payments. And so your pension payment on the federal level is an income taxable event that's taxed at ordinary income rates. And then if you so choose, I suppose you could make a lump sum check payable to yourselves. And given the year that you make that event happen, you will pay income tax on that. And of course, on a caveat, or in addition to that, you're also going to pay a 10% penalty if you are not 59 and a half. So be crystal clear that this is a very tax sensitive scenario, that if you're deciding to take the lump sum, and unfortunately, I've had some conversations with folks over my 25-year career that have done this, and it was unbeknownst to them that they thought they could just take their lump sum and put it in their checking account and live off the money for the rest of their life if they so chose. Which you could do. Just understand that there's some caveats to that, where it's going to be a large taxable event to you, and it's possible that you're going to pay a 10% penalty if you're not 59 and a half when that takes place. Now, as a, of course, benefit to working with a partner such as the retirement group or anybody who can help you transition those funds from your qualified retirement plan into an IRA, the rollover of those funds are not taxable, and that is not a penalized event as well. So it's possible that as long as you check the correct boxes and you do this in this event and the steps in the event that allow you to do this on a rollover basis, which is completely tax-free to you, you will have no tax related issues or complications. Traditional IRAs and 401k taxes, of course, I just spoke, whereas if you're removing money from a traditional IRA or from a 401k, it is taxed at ordinary income rates. The difference could be significant to the extent of what gets withheld from the withdrawal. So as an example, there's a mandatory 20% taxable withholding rule if you move or remove money from a 401k. And it's possible that you're not in the 20% tax bracket, so you might be overpaying as per se, like holding too much from taxes with respect to what you hold or what you take out. And so as a comparison, if you were removing money from an IRA that we helped you establish at Charles Schwab, because that's where we host funds, we could tell Charles Schwab to withhold 15% from your taxable withdrawals. And that way you're not taking an additional 5% out from your qualified retirement plans that would make it mandatory you withhold 20%. So just understand that the withdrawals from this, and most people are aware that it is a taxable event to you. And the only catch or caveat is if you're over or under 59 and a half, because if you're under 59 and a half, there's a 10% penalty that's going to be associated to that as well, unless as a substantial equal payment is paid to you, which is under the rule of 72T, or you're withdrawing monies from a post-55 separation, which I encourage you to check out one of the links that Sam dropped in the chat, because we talk about that further in a different presentation. Managing your taxable accounts is unique, whereas maybe you inherited some money, or maybe you've just been able to save money over the years in an ordinary account, in an ordinary brokerage account or a joint account that you share with your spouse. And of course, as if you're doing that, you'd be familiar that the income that you're earning is taxable to you. So the interest that's being paid on, let's say that's in treasuries and CDs, and maybe you've got some stocks and bonds and stuff to pay dividends, you're going to pay taxes on that. And the only question is if it's correlated to capital gains or qualified dividends, which will dictate what payment or what amount you're paying on those particular distributions. And so this is a unique situation, but certainly one that we want to give a bunch of credence to in the event that it's part of your planning process, because it's possible that it might make some sense for that account to be structured in a tax free or a tax favored environment, where maybe you're buying investments in there that don't pay these ordinary dividends, or they don't pay capital gains, and you don't have ordinary income or taxable treatment from those distributions in the given year that you own them. And so there's a lot to consider with respect to managing your taxable accounts, but certainly something that relevant to our discussion today, whereas it might apply to some of you. Withholding and payments, I talked about this just a few minutes ago, but adjust withholdings on your retirement account, distributions in your 401ks to match your estimated liabilities. This is a big deal, because if you're accustomed to getting a large refund, as an example, during your working years, some people use that as a forced strategy to have spending money so that they can take family vacations and so forth, because they're drilling and honing in on trying to save as much money as humanly possible while they're working, which is fine. But once you move to or transition into retirement, I'm not confident that that's a 100% favorable scenario for you to have your tax situation managed. And so you just want to make sure that we're matching or estimating roughly what it is that you end up paying or need to pay with respect to your withdrawals, and where that money's or those funds are coming from. And so we want to make sure that we're withholding rate updates as they change from a given year. And in the event that you are in a position that you want to make quarterly estimates so that you don't end up paying taxes and penalties on those deferred payments that you're ultimately not making to the IRS until the given filing of your tax return. And so if you have rental income, or if you have self-employment income, you want to make sure that you're not choosing to self-direct and ultimately pay one payment, whereas you're being charged penalties and interest because you're not making quarterly payments in those scenarios. So that's something for sure to look out for certain. The checklist, just a kind of a quick refresher on the deductions. We talked a little bit about property deductions as far as state and local taxes. The mortgage interest that you have, we talked about how that's changed in the most recent few years. Your 401k and your IRAs as far as the deductions for your contributions, et cetera. Credits that are related to child tax, adoption, solar credits and electric vehicle tax credits, and et cetera, that are all relevant to tax credits that you could potentially have as a positive result of adding those things to your household. And then as far as the taxable nature of your Social Security payments, which is dependent on the other household income that you have. And if you live in a state, for example, that's not being a state related tax to your pension payment, that is something to consider, as well as the other contributions and deductions that you have and withdrawals from your 401k and your traditional IRAs. All something that we've touched a little bit on this afternoon. And so the catch to a lot of this is, if this is news to you, if any of the things that I've talked about today are something that you haven't heard of before or you're unfamiliar, it's likely because you're grinding in the everyday life of how it comes quick at us with respect to working and trying to get to the finish line, so to speak. And most people that we run into, especially 74% of the people over the age of 50, they don't have a written financial plan. And the good news is there's no excuse for that, because firms like ours do it as a courtesy to you so that we can introduce our services to you. And it gives you a way to potentially hone in on a firm, for example, that might be a good fit for you and your family as a partner to transition into one of the most difficult decisions that you'll ever have to make, which is financially related to retirement. And so you might want to consider the retirement group, is because we have a ton of experience in the corporate retirement world. And we have offices all across the country. We have an intimate knowledge of most of your 401ks and your savings plans and your retirement plans as far as your pensions are concerned, as well as your healthcare benefits. And as I mentioned just a minute ago, we offer a complimentary cash flow analysis, which is free of charge to you in the event that you are open to spending a few minutes with us. And so the way to reach out to us in the event that any of these things make some sense to you, or that you want to know more about this, is to email us at info@theretirementgroup.com. You can also call our 800 number, which is 800-900-5867. If you wish, you can schedule a meeting with either myself or any one of my colleagues by taking a picture of this QR code to the left, and it would get you access to our calendar where you could choose a time that's convenient for you. And if you're not already following us on LinkedIn, we have company-specific LinkedIn pages that are relevant to potentially some of the companies that you work for that might be in your best interest to follow, as we have a ton of great information and data and things that we talk about on a regular basis there. So if you're not already following us on our LinkedIn page, I encourage you to do that. And so with that, I hope you found some value in what we had to talk about, albeit a ton of information that we covered today. And many of you may have some specific questions on how some of these things could be correlated to you and your family. So I encourage you to reach out to us, because we're happy to help you in any degree we can. And although we're not tax professionals per se, we're financial professionals. We have a lot of value to bring to the table with respect to how some of these things would actually apply to you and your family. So with that, what I'll do is pass the information back over to Sam to see if we have any questions before we let you go for the afternoon. Sam?
Thank you, Patrick. Yeah, let's answer just a couple questions. But first, as a reminder, once this presentation has ended, you're going to be redirected to the Retirement Group's homepage, where you can book an appointment with Patrick or one of his colleagues and take advantage of other resources that we have available for you on the website. Alrighty, Patrick, you ready for the first one?
Yes, ma'am.
Alrighty. At what age can I make extra contributions to my 401k and IRA?
Ooh, good question. 50. Unfortunately, I am there. And so I can prove to you in personal scenarios, you get the credit of adding additional monies to your retirement plan. And so the rule states that if you are under the age of 50, there's a guideline in this current age of 23,000 that you can add to your retirement plans on a pre-tax basis. By the way, for those of you who are adding money to the Roth side, this would also be part of what you can contribute in up to the 23,000, even though it's not a tax favorable benefit to you today, because it doesn't reduce your income liability in the year that you make the deposit. But the answer is 50. And then once you get over 50, they allow you to do something called a catch-up provision. So if you're ever wondering when you go log into your 401k contributions and you see the part where it says catch up, that's what they're referring to. So if you're over 50, that's the answer. You can put more money into your retirement plans.
All righty, thank you. Next one. Will my Social Security benefits be taxed if that's my only income?
Yes, for sure. Well, let me back that up. I guess it depends, is really the technical answer. Okay. And it depends on how much it is, because if you fall under the guidelines of, I want to say it's $10,000, there is no taxable nature to you, but I'm guessing that your Social Security income is going to put you at least in the 12% bracket, which means you're going to have a taxable nature to your Social Security payment. And it would probably be closer to the 50% threshold of what is relevant to how much you would actually have to pay. And the good news is, remember, if you're not already doing this, you would want to consider, if you're actually taking Social Security, that you can ask them to withhold what you want to send to the IRS. So there's an ability for you to withhold some taxes from your Social Security payment to help you manage the amount that you could potentially owe and or get back. So if at the end of the year you're finding you're getting a large refund, you're probably withholding a little too much for your current scenario, especially if it's your only source of income. And then if you're having to pay in, you're probably not withholding enough. And so you might want to increase that as a consideration.
All righty, thank you. Last one. Do I pay taxes on pension income if I live in a state that doesn't tax pensions?
Yeah, the answer is that it depends, and it depends on what state you live in to qualify if you're getting pension income from the person or the company that you worked for. So remember, pension income is derived from a corporate or a qualified plan, right? So if you remove money from an IRA, it's going to be considered ordinary income to you. So this is all correlated to the state that you live in, because some states do and some states don't. I imagine at some point in time we may get to a scenario where all states are similar in that, but they're not. So it's certainly specific to you and your specific state. So I would encourage you to check the rules, and if you have further questions about that, your specific situation, make sure you call us and we'll do our best to help you with your state specific scenarios.
Definitely take advantage of that complimentary cash flow analysis and contact Patrick to speak to him specifically. Alrighty, Patrick, that was it for today. Any last thoughts you want to add on before we go?
No, hopefully we're all in a position to be on time to get your returns done, because that time is creeping up on us here in the next few weeks.
Yeah.
And if you have specific questions about something that might be relevant to your situation, as I mentioned to you, the best thing to do is to reach out to us. So hopefully you found some value in what we had to talk about today. And until next time, we'll see you.
Thank you, everybody, and thank you, Patrick. Hope to see you guys soon.
Take care.
Bye.